Hello again, fairbinaryoptions.com here. The second part on our bullish and bearish engulfings, explaining the patterns. Now, if on the first part we look a bit at the theory and what it really means, it is quite a simple concept. A bullish engulfing requires, or such a pattern requires, only two candles. Of course, a bullish engulfing requires one red candle followed by a powerful green candle that should engulf, or that should go beyond the body of the previous red candle. This is being called engulfing. And of course, a bearish engulfing means that the second candle is a red one following a green one, and the body of the second candle should engulf the previous candle. Now, this is a reversal pattern. The higher the time frame, the stronger the pattern. So I will write here as another important thing to consider that such a pattern on the 5-minute chart means something. Such a pattern on the 1-hour chart or 4-hour chart or the daily chart means a totally different thing. So the higher the time frame, the stronger the pattern is. And again, this is a reversal pattern. Now let's try to identify some bullish and bearish engulfings on this Euro-US dollar 4-hour chart, and how to actually trade binary options based on them. Now, for example, this one here is this is a bearish engulfing. As you can see here, price is going to the upside, okay, and the following candle engulfs almost entirely the previous green candle. It is not a full engulfing, so therefore we are not going to consider it. This is also not a bullish engulfing. We are not going to consider it. What would be considered as a bullish engulfing? Remember what we need for a bullish engulfing. We need a red candle followed by a strong green candle. So this one here would be considered a nice pattern in the form of a bullish engulfing. As you can see, we have a red candle to the downside, and the second candle goes and closes above the opening price of the previous red candle. Now this is a bullish engulfing, and normally we should engage into buying call options, so we should look for market to keep moving to the upside. However, when should we buy call options, and with what expiration date? Well, first of all, it depends very much on the time frame the pattern is identified. Second of all, never buying, even though sometimes because of this situation we may miss some trades, never buying a bullish engulfing, or never buying calls or puts by the moment the candle closes. Wait for price to retrace 50% on the second candle there. So in a bullish engulfing, wait for price to retrace in the 50% of this candle, and then engage into buying the calls. On a bearish engulfing, wait for the price to retrace 50% and then engage into buying the puts. So basically, you would like to buy call options here after the bullish engulfing is identified, or you would like to buy call options here. With the expiration date, depends very much again on the time frame that you are looking at. This is a 4-hour chart. I would like to buy call options here with a short expiration date, something like 1-hour expiration date, or even 2 hours for the brokers that allow that, or maybe depending very much on the moment of time during the day, I would still like to buy them. End of day expiration date, or even end of week expiration date. Why not? If this is a Thursday, I would buy them again here, okay, on the 50% level with expiration date, end of day expiration date. So this would be a winner. Now let's try to find also a bearish engulfing if possible. Now I would say that this is a bearish engulfing on the 4-hour chart here. As you can see, on a bearish engulfing we have a green candle followed by a red candle, so bearish engulfing conditions. So we would like to buy put options now, but not at the moment that the green candle is closing there, but on a 50% retracement, something like this. This would be the moment of time I would like to buy call options as trading this kind of pattern. So let's write here what does it mean. Or how to interpret it. So on a bullish engulfing, buying calls on 50% retracement level of the green candle, or when the green candle is retraced by 50%, okay? And of course that the other way is exactly valid on a bearish engulfing. We are buying put options. Why put options or puts? Because we're looking for price to go to the downside, and these are the classical examples that I wanted to show you. Now you have to imagine that because these are reversal patterns, bulls after a downward trend will try, this being a bearish engulfing, bulls will try to keep testing the upside there, and this is why a 50% retracement is mandatory. Sometimes you'll see that the reversal pattern is so strong that you don't even have the chance of looking at let's say of entering the market, because the market will just continue and the 50% retracement is not coming. But better missing some trades than staying only on losing ones. Therefore, this is how properly you should trade binary options with reversal patterns, in this case bullish or bearish engulfings. We will continue our educational series on fairbinaryoptions.com throughout the 2014 year. We'll add each week 2 different strategies and 2 different concepts. So either you are beginners in trading or you are medium to experienced traders, we will say that you'll have to benefit from these recordings, from this analysis, as new approaches to trade the currency markets, and in this case to trade binary options based on the currency market assets, are going to be brought each and every time. Again, thank you for being here. fairbinaryoptions.com, and all these recommendations are due to our official sponsor here, Live, and of course all of them are going to be uploaded on the YouTube channel and tweeted on our official Twitter channel @fairbinary. Bye bye.